You've been watching decentralized finance for a while now. Seen some people make a fortune, others lose everything. You want to get involved now, but the complexity is insane. The risk, unbearable. Let's face it, you have no time to specialize in decentralized apps, and no money to lose either. Well, there is an easy way to earn returns from DeFi. A solution with no trading involved, no hassle. A place where you're always in control. Just deposit funds and watch your savings grow. We're talking about an app. We're talking about the Yield app. DeFi banking in your pocket.
Hello, 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 and welcome everybody to the second in our exclusive webinar series with Yield Labs founder Kevin Bradford. My name is Rebecca Jones. I'm the head of communications. Kevin is joining us to give us another really thrilling insight on how to build the perfect crypto portfolio. How are you doing, Kevin?
All good. Can you hear me? All clear?
I can certainly hear you.
Beautiful, nice little sound check. So yeah, thank you, Rebecca. Really excited to be back, and let's try and add some more value to the audience and give them a little bit of a different perspective in terms of like how to approach this crypto space and how to use the tools like the ones you provide. And yeah, all good. I'm excited for the conversation.
Yeah, absolutely. For anyone that wasn't in on our first webinar with Kevin, you can access the link to that via our Telegram channel. And also we did send it to you via email. So check that out. But effectively, Kevin's doing a series in which he's showing us how to approach crypto a little bit differently. Typically people, especially people that are new to cryptocurrency, they might be looking at trading opportunities or the next big moon or the 100x kind of investment. And actually, Kevin's taking it from a much more long-term perspective. And how can we build a portfolio? How can we actually make crypto work for us in a passive way sometimes, especially if you've been lucky enough to participate in some of those early booms and now you've got assets that you can make work for you, or even if you're new to the space and you've got no idea how you might just put together maybe a fairly sensible portfolio. I think it's fair to say there's something in this for everyone, right, Kevin?
That's it. And then it's like, it's not about spoiling the party and just no speculation or not trading. You can use these tools and techniques, but it's also kind of just a perspective. If we do, and people do end up kind of hitting a 100x, like you say, which is possible. People have done it, and there'll probably be more opportunities to do it. Maybe YLD will do it one day. Not financial advice, but once that opportunity happens, like you need to kind of know what to do and how to approach. You can't keep using the same approach over and over. And obviously we have different cycles and different events happening in crypto. So yeah, just kind of a different mythology to kind of align, and just something to think about with your kind of strategy and approach, I would say, to crypto.
Right. Okay. Well, let's maybe just jump into what we're going to talk about today. I mean, I think perhaps last week, if again, for people that didn't tune in, if we could give a kind of a rough summary of what was discussed last week. I mean, effectively, we were looking at really what the core elements of the portfolio were, correct?
Yeah, so we looked, it was kind of an overview, I would say, last week. And this time we're going to probably slow it down a little bit, and then we can get more engagement from the audience, more engagement from yourself. And it was kind of just a summary of kind of crypto as a business, if we approach the balance sheet and the portfolio as a business. So we can go back over some of that this week, and we can look at other elements. And basically, yeah, we'll just dive into some of these elements and sections a little bit deeper, and try and just pull out some idea of mythology just to kind of share with people, and then they can kind of do with what they will, disagree, agree. It's all good, right? There is no one way, and everybody's different. So it's kind of just about putting a toolbox full of tools and then just choose which ones you want.
Right, take what you need and leave the rest. We are also awarding 100 YLD to the 5 best questions, and I can see that we've already got some really excited users trying to participate in that. So we will be taking those questions at the end. One of our lovely glamorous assistants is going to be hand-picking the best ones that are most relevant to our presentation, and they will each win 100 YLD each. So keep sending them because yours may be better than somebody else's. We'll let you know. All right, so let's kind of jump in. Did you want to share your screen, Kevin?
Yes, please.
Let's
share that and tell me when I'll do some brief introductions just for those who don't know who I am. Just let me know when that's
perfect.
Live, Rebecca.
Here we go. Yeah? There you are. Yep.
Okay, yeah, so we're continuing on from last week, basically, or 2 weeks ago when we did the kind of businesses work for you so you don't have to work. So basically looking at the portfolio in a different way. So we're going to do a couple of introductions and we're going to just cover briefly what we covered last week in terms of, is there a different way to approach this space? We're going to look at kind of a diversification, infrastructure and speculative assets this session, and we'll kind of tie that in with a worked example and kind of a seasonal approach and when you would need to kind of deploy these types of techniques and approaches. So yeah, then we'll obviously as we go through, we could do Q&A and Rebecca could jump in anytime she likes. So and we'll just do a backwards and forward session, and it'll be really good to listen to, hopefully. So yeah, obviously not financial advice, anything we're going to say. We're not telling anybody what to buy. We're not telling people anything that's going to do 100x. We're joking around when we're kind of suggesting YLD is going to do that in the short term. So obviously take long-term approaches, and we are not financial advisors, so we're just trying to provide educational content just to kind of enjoy and digest. So just quickly,
yes, very important caveat. Very important caveat. Not financial advice. Yeah, just to be clear.
That's it. Let's just do some education. All right. So yeah, a little bit about me. So just those who haven't seen the first session or don't know anything about me, I'm kind of I was originally just a blue collar worker, kind of college dropout, not because I was stupid, just because I kind of didn't know what I wanted to do with my life. And I was kind of floating around the education system, ended up in the British military, which obviously I wasn't floating. I ended up not floating when I was there. That kind of focused me, and I had a telecommunications career there. I worked on tactical communications and satellite communications. And then I ended up in the oil and gas arena. Had a decent career where I worked my way up from kind of project manager or project engineer all the way through to kind of project engineer, program manager, and I was a high-level operations manager by the end, looking after the Middle East and North Africa. My screen's just gone off, but I think the presentation will still be live, so I'll just continue to talk.
Yeah, I think it's you're a little glitchy, actually, Kevin. If there's anything you can do to boost your connection, that would be really helpful, I think. Okay, it's a little glitchy.
Yeah. So let me know if it's unworkable, but I think we'll just have to carry on like this. So yeah, basically I retired from that in 2019 after like a 14 year career, and I got into crypto in 2017, and I became fascinated by the category of yield and yield on digital assets. I was early to that party before it was a party. So I kind of just watched that journey, and I really enjoy just working in the space now in terms of a yield expert. And then we founded Yield Labs in 2021, kind of put a wrapper around a lot of the work that we've done over the previous years with other companies and protocols. So as I said, we created Yield Labs, which is basically we just look at the category holistically and look at pieces of infrastructure and tools and platforms like Yield app and all of the others, the DeFi and the CeFi plays. And we've built our own community where we can kind of come together and share this knowledge together. And we're always trying to provide maximum value back to our community in terms of the best content, all free, and never charging our community for anything, and just creating a great vibe in the community. So it's all inclusive. So we welcome in any projects or protocols. We try and just facilitate everybody. We try and find the best people from each community and then put them in there so that we can facilitate discussion. We do a lot of different content, the typical YouTube format, articles, Zoom, social media. And we believe that this offering is kind of disruptive in terms of we're not offering paid content. And we believe our content's better than most of the paid stuff out there anyway. So we do partner with people who do offer paid content so people can take it if they want, but we don't do that ourselves at the moment. So yeah, all unbiased and just backed by data and the facts, and we just present the facts to our community. So we're also trying to showcase the best talent that we find. So anybody from experts from each community or anybody that can add value is welcome to join. Come and join our panels, come and speak with us and help our community grow. And that's kind of and obviously we want to find people a lot better than myself, and then we can kind of replace me with the better people. It's not a closed format. We welcome anybody who has the experience and wants to participate, you can come in and get involved. So yeah, and then finally, we're trying to really drive the industry to a higher standard. So companies like YieldApp, for example, if they are offering promises of X, Y, and Z, then we obviously will measure the company from the external perspective and make sure that they're delivering promises, offer improvements as we see them, and kind of just add value to them as best as we can. And then just so we're basically trying to drive a better user experience for the end customer. And any revenue that we do make from companies, we give 90% of it back to our community, because that's not how we really monetize what we're doing. We do work with businesses on advisory roles and different things, but anything that most of it just goes back to the community in terms of giveaways and just giving maximum value back. So you can find us on these channels if you want. Please come and join. That's kind of all we ask. Just a subscription and a like and a few shares on YouTube, and we've got a website and Twitter, and obviously the Telegram as well. You'll find that. So basically, we will jump straight into this, which is a slide from last week. But for anybody who didn't join last week, we just want to kind of refresh why we're kind of looking at why this presentation exists, really, and then what we're trying to achieve. So.
And these are the perspective and approach. So these are the key principles when it comes to thinking about building a crypto portfolio or getting started in crypto, or both.
Yeah. So basically, this is the traditional kind of buy low, sell high is kind of how people come into crypto. They're like, okay, I can buy an asset, it can appreciate, then I can sell it, then I can take all my money back out of the system. So what we're really trying to do is just change that mythology. You know, that's okay to kind of take that approach, especially if you try to get somewhere. And then obviously diversify it as well while taking that approach. But the portfolio is evolving, and with tools like Yield app and all the other players in the space, then you can basically do a lot more.
Okay.
Yeah, sure. Sorry, Rebecca.
No, I was going to say, when it comes to buying low and selling high, obviously this is the ideal investment approach. You know, this is what, you know, everyone from Warren Buffett to probably Elon Musk try to do. But how do you do that? Because it's very difficult to not get caught up in kind of the market frenzy, right? You know, something's going up, 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 you buy, something's going down, 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 you sell. Do you have any little tips there on how to maintain that buy low, sell high mentality?
Yeah, I think firstly, like, the promise of crypto is a lot more now than you know, back in 2017, 2015, whenever the early days, it was very, very, that was kind of all you could do with these assets. The promise that they would have utility and be able to do different things, what was there, but there was actually, the reality wasn't there. So I think yeah, buying low and selling high and making a profit is obviously a part of a strategy, and probably most people want to do that. But it's kind of looking at why you are holding that asset, having a story, not just, okay, I think this is going to go up. That's not really a story. Having a narrative as to why you would want to hold that asset. What's the future? How is it going to get to this place that you think it's going to get to? Tracking that. And that's a lot of what we do in our community. We kind of track these trends. We do that with your company in terms of the data, and just to basically present that to our community, just so they can kind of see, you know,
so
okay,
have a system around it, basically.
Yeah.
Have a system,
okay.
and that helps you do that whole kind of buy low, sell high thing.
That's it. So yeah, okay, Wildy's going to go up. Why is it going to go up? AUM has to go up. The users have to go up. So we have to track these things. And if that's your story, and then you're constantly digging into Yield app and understanding how they're monetizing, where the revenue streams are coming from, you know, that's a good narrative. So, and then obviously there'll be a time when you want to kind of convert that into another asset, maybe potentially on the books, or hold it forever, depending on your approach.
Okay. And then we've got point number 2, portfolio components. Could you run us through what these components are?
Sure, yeah. So basically, just like any functioning business, you kind of have assets, liabilities, an entity, equity. I've put because we are able to buy equity in you know, companies in the space. So that's a strategy, and then a revenue stream as well with the assets that we've kind of have, and then the ability to sell something in our shop, for example, if that's our business. So if you really break down the portfolio, it actually resembles pretty much a business. So that's kind of what we're indicating here, that yeah, it's basically, it is a business. A portfolio is a functioning business, and we should really approach the portfolio as a business rather than approaching it like, a speculative, let's buy low and sell high um,
Yeah.
approach, which is very kind of immature, if I'd say, from an investor standpoint.
Could you give us an
It,
example of an asset, a liability, an entity, an equity, and revenue, or just what a portfolio might look like with those five different
Sure,
components?
yes, that's it. So assets are basically any digital asset. So you could have USDC, Bitcoin, Ethereum, whatever you want. Obviously, the liabilities are the ability to kind of collateralize those assets. And what do we mean by collateralize? Kind of borrow against, just as you would with a traditional house or something like that. So obviously, we have our own entity. Your entity is kind of your geographical location where you're setting up your business, and then equity, we are able to buy equity in other businesses such as yours, and we can use platforms like Banks of the Future to create an equity portfolio alongside our kind of assets and our liabilities. And then obviously we can create a revenue stream from the assets, and that's kind of the core business of Yield App, offering revenue on assets, and basically Yield App taking those assets, generating revenue, and then giving you a good portion of that back in a
Okay.
fair transactional way.
So an entity is like owning a company, or
Yeah, basically, yeah. So when I said entity, it's kind of like your own personal entity. So I sit here in Dubai. I have, my own company. I have my own portfolio. I run things through that. So everybody's entity is kind of basically wherever they live, and then you can, kind of com commercialize that and put that into a structure or corporation or whatever that's called where you live, or you can just run it as an individual, as a private portfolio. So just referring to kind of like your business structure, how are you going to set this up? Are you just going to hold a portfolio on
I see.
Blockfolio, and
Okay.
or are you going to actually like incorporate and then you reap the tax benefits that way? So kind of
I
just
see.
thinking about it that way, rather than just buying, creating a massive tax liability, getting yourself in trouble, and then not knowing how to pay it.
So it's actually looking at your portfolio more like a business balance sheet rather than
Yes.
these being components that should be inside the portfolio. This is actually, well, this is kind of me as a business, and I want my assets. These are my liabilities. This is me as an entity. This is my equity. This is my revenue. So you're looking at yourself like a business, really.
Correct. Yeah. And basically
Okay.
always making decisions based on kind of that approach, right? So if you don't take this, if you have a business and it's a shop and let's say it sells bread or something, you're not going to just start buying a load of kind of chocolate and then putting that on the shelves. And that's kind of what people do in crypto, right? They purchase an asset, they're like, this is a great asset. And then they just all of a sudden run away somewhere else, pick something completely different because they think it's going to go up, chase it or whatever. You know, a bread shop wouldn't see someone selling ice cream down the road and then all of a sudden, okay, ice cream's selling well, let's sell some ice creams as well. It's kind of, it doesn't really work like that. So if we kind of think like a business, we can make sensible, sound investment choices like a business, and then we'll probably protect ourselves as well at the same time.
Got it. Okay. And then we've got a new point here, perspective.
Yeah. So basically, how are we going to denominate that portfolio? So either in dollars traditionally, or whatever currency that you kind of use in your own country, or are we going to look at it in kind of token and coin and asset denomination? So do we measure the portfolio in Bitcoin? Do we measure it in YLD? Do we measure it in whatever expression you have, and whatever way, everybody has their take on this digital asset market, and how are you going to kind of just denominate your portfolio? Having more Bitcoin at the end of the year, is that a success if the dollar amount of the Bitcoin is lower? And I know there's a lot of debate, and people kind of see it both ways. So some people just want the raw dollars, but dollars are depreciating assets. Some people want more Bitcoin, and Bitcoin's an appreciating asset. So basically having a view on kind of crypto, the whole macro picture, and then kind of how we're going to plug that into kind of how we measure and value our portfolios.
Okay. Interesting. So doing a kind of US dollar valuation of your portfolio, as well as like a total, for example, Bitcoin valuation, or you're saying you should choose one or the other?
Probably, I would, yeah, like, so obviously the US dollar is a depreciating asset. So unless we're earning 20, 30, 40, 50% per year, we're not outperforming the debasement of that asset. So Bitcoin, if we have one Bitcoin at the start of the year and then we have 1.2 at the end of the year, that's an appreciating asset, right? So that's a great, so it's kind of, it's not saying that the dollar approach is wrong. It's saying if you're going to take the dollar approach, then you better outperform debasement, and you basically using tools like yield app to kind of outperform what you can get in a bank account. And then basically, yeah, you better be outperforming significantly, kind of just, okay, I got $100, now I got 101 at the end of the year. You've lost a lot because you've lost 15% of your purchasing power at the same time. So, via inflation and different things. So just having that approach and that perspective, and then, kind of, even a lot of people don't even think about this stuff. They're just like, okay, dollars, yeah, I have more than I had last year, I'm doing well. But really, you're probably not. If you'd have just took a Bitcoin approach, maybe you'd have, increased your Bitcoin. Yes, your dollar approach would be less, but a year later, it'd probably be, twice as much. So I'm not saying what to do. I'm just saying, just think about it, and then have your own perspective.
But I guess the key to that would be something that I think we're going to touch on anyway, which is diversification, right? Because if you have a portfolio that is well diversified between lots of different assets, then you should be able to get the best of all worlds to a certain extent, no?
Yeah, and it's kind of diversification. Diversification is, it's again, all of these kind of topics, it's kind of understanding the topic. So diversification is great, but if somebody has $1,000 and they want to get somewhere, probably the crypto market is going to be your safest bet. And then kind of in terms of being able to outpace anything, I'm not suggesting people do that, but so diversifying $1,000 between 4 asset classes, you're not really going to get anywhere. So there's times to diversify. There's times where diversification within crypto. There's people I know that are just 100% in crypto. So it's kind of, and then they diversify within that asset class. And there is and you can do that with different products like gold, tokenized gold, and different things now. So diversification is very, very important. And it's kind of, but understanding when, how, and what asset class to put that in across. Obviously, if you're inside crypto and then you generate significant X's on your capital, then diversifying back out is obviously a smart move, right? Buying physical assets to complement your kind of increased portfolio that you have in the crypto assets.
Great. And now we've got point number 4, approach and mindset.
Yeah, so basically, as I've mentioned, those just basically complement kind of everything that we talked about before, having that kind of perspective and the components, and then obviously an approach and mindset to go with that. So just a longer term approach, as I mentioned, coupled with kind of your denomination of how you see the space with sound risk management and a high quality balance sheet, not just a balance sheet kind of or portfolio full of speculative altcoins. Is kind of probably the only way, and a lot of time to kind of outperform all of the volatility in the market. Obviously, the volatility is all short-term events, but if we take a longer-term approach and we come back in 2 years, buy assets with a 2-year time horizon, generating yield at the same time, generating more coin rather than more US dollars on those assets, if that's what we want to do, then in 3 years' time, those assets have significantly increased if it's the right asset and it's a high quality asset. So it's not about trying to achieve maximum at any one time. Okay, I've got 3 months, I want to make as much money as possible, buy a car, get back out of crypto, and then you're basically the same position that you started before, but you have a car, and that doesn't really help your life. It's about kind of creating this passive income, long-term approach, high quality assets on your balance sheet with a high yielding portfolio, and that's where you get the freedom in crypto. That's the real promise of crypto, and the freedom to kind of let your business or your portfolio just work for you, so then you don't have to work. And that's what we at Yield Labs and a lot of us have kind of achieved via this approach.
Yeah, absolutely. I'd love to break for one question, if that's all right, Kevin.
Sure. Yeah, absolutely.
So we've had a question come in from Malcolm Aguis, I think, Agius on YouTube, and he has asked, do you suggest taking a fundamental approach for a long-term investment in crypto?
So is he talking about like fundamental analysis, basically on the underlying kind of investment, I guess. That's kind of, I'm going to take the question as that, and if I'm wrong, please correct me. So
let's
just a
take it as that, and then maybe let's take it, because I guess another way that we could think of fundamental is, you might fundamentally believe that Bitcoin is a great asset, or just kind of basically regardless of the price. So perhaps there's those two different meanings. You know what I mean? Maybe you believe in the project, but not necessarily you're looking at the price. Could be one of the
That's
two.
it. You can take it anyway, but yeah, obviously the fundamentals are probably the key. So I guess the easiest way to look at that now, and the best analogy would be Bitcoin right now, where we kind of have this, I would say, stabilized kind of choppy price action and no clear direction in the market. But what we have is a kind of a fundamental undercurrent of accumulation and dips being bought, and basically, so the fundamental, what I'm trying to say is basically the fundamental picture and the technical picture don't kind of align right now. So those that can kind of understand Bitcoin, what it is fundamentally, and you can apply it to any other project, will be buying Bitcoin now. Those who won't will be kind of waiting for Bitcoin to crash to 20 or 15, and it'll probably never get there. So yeah, understanding fundamentals is absolutely important. But it's more, and also it's like, it has to fit in with your kind of, everybody's different, right? Some people are technically, have a technical brain. Some people have a brain that works different ways. So find assets and narratives that kind of align with your skills and what you can kind of digest. And there's 100 different ways to do this. It's not about this is the right balance, this is the right portfolio to buy. It's kind of like what makes you feel good, what makes you hold long term, and kind of the psychology behind all of this at the same time. So when I work with clients, I don't just put them in the best structure to make money. I put them in the best structure, in a structure, but basically something that keeps their mindset very, very calm, and they're happy. And then if you're happy, you're not going to do anything silly. So it's kind of finding that kind of grouping of all of those factors.
And is it good to combine that with a long-term mentality?
Yeah. So like obviously, and then long term, the only way to really outperform this market is long term. You can trade and you can do this, that, the other, but crypto moves so fast. You're never going to be able to, if you're not in position. So you look at what happened in whatever it was, March 2020. If you weren't in position before that, we went from 10K to 65K, I think, in like 12 weeks. If you weren't in a position, in a long-term position, as a lot of us were, you were no way you could catch that. And then everyone was interested in buying it at the 40, 50, 60, $65,000 levels. So you have to have the long term. It's the only way you will outperform the market over a 2, 3, 4, 5 year period. And it basically, if you buy, it's not financial advice, but if you have bought any of those assets over a 5 year period, you've outperformed the market probably, in any trader or anybody, just because you catch those massive upswings. Doesn't mean you've been able to sell the top, but you've ridden that wave, and that's the only way to ride the wave. If you're in position with a long-term approach, you're never going to just catch these moves. They're too fast. The market's way too quick.
Okay, well, there we go, Malcolm. Yes, take a fundamental approach, combine with long-term, and that's probably a winner. But remember, we're not financial advisors.
Yeah,
back to you, Kevin.
Yeah, that's it. And this is very, very difficult, right? This is very difficult to do because, as you're identifying, Rebecca, there's a lot of different components required, right? So there's 100 ways to skin it, and you do need to kind of develop your skills from kind of a technical when to buy approach, a long-term mindset approach. You have to master your own psychology, kind of understanding fundamentally as the viewer asked the question. So it's not like we can all come into crypto and then day one be experts, but that's what kind of companies like Yield App are for. If you don't understand what you're doing, buy dollars and put them in the app, and then you're already like earning 20.5% on the dollars. So that's a great starting point. That's an amazing starting point. You're already outperforming the banking system by 10x, 100x. So you're already winning. So now let's take the time, let's learn. And then if we want to go off and do advanced strategies, DeFi and this stuff, we take the risk, but then potentially we can achieve more.
Perfect.
So yeah, so basically, as we discussed, the portfolio is a balance sheet with these four main components on, and there are kind of four categories which I kind of just define myself as in stable assets, stable coins, value storage, and speculative and infrastructure. So we've covered kind of these in this in the last slide. So if we just move on to kind of speculative, or what I call kind of call them non-functioning assets, and I put kind of some examples there on the right side, but please ignore those. They're just kind of plucked out, and some of these probably are functioning assets at the moment, but
Right, because
I
that's
just
such
can't
an
keep.
interesting debate, isn't it? Like the idea, what is a functioning crypto? Because I think that a lot of people say, well, cryptocurrency is all of it's non-functional. It's just an idea. It's just a fantasy. But, and then you hear, and Dogecoin is based on a dog, right? But then you hear that actually Tesla might accept Doge as payment, or,
Yeah.
even Apple might accept Doge as payment or whatever. And then of course, we're into that theoretical world of what is currency, what is value, and so on and so forth. But what is a real speculative non-functioning asset in your view?
Yeah, so these are my opinions. So this is not like a market definition or anything. So basically, I've written down some points there we can cover. So it's basically, I see it as an asset where we're basically buying it and hoping that it turns into a significant multiplier or percentage above what we so we basically park capital in it and then we wait. So we have to ride a lot of volatility. We're not really able to do anything with it in the meantime. So and it's non-functioning basically. So you're not able to kind of collateralize that asset, i.e. deposit and borrow any money against it, just like you do with a remortgage. You collateralize your house and then you borrow money against it. You're not able to generate any yield, so you can't deposit it on Yield app or anywhere in DeFi. You can't create a revenue stream. You're not really able to put the asset to work in any way. You're not able to, in terms of like automated market makers or like liquidity providing positions, so you're not able to generate yield that way. Basically, just something that's going to sit on your balance sheet as kind of stock that's hopefully you're going to sell one day. Like it's just kind of a high risk stock, I would say. So with that in mind, it's kind of stagnant equity that we really need to kind of size the allocations accordingly. So we can kind of look at it like, if we turn like 1% of our portfolio into 10, that's like a huge swing. And then that's really meaningful to the portfolio in terms of its overall yield generation. So I think far too many people kind of do it the other way around. They're like, this asset is, going to do a 3, 4, 5, 10x, and then they kind of put the whole portfolio in it, and they turn the whole portfolio into kind of a non-productive balance sheet, which is not really generating any returns, and then has the maximum volatility and the maximum kind of downside if it goes against them. So allocating risk accordingly is fine. Understanding if we're going to take more risk, okay, Kev, I want to take more risk. Okay, as long as you understand what you're doing, what is the asset, how is it going to get to the place that you think it's going to get to? How are you going to track that? How are you going to make a decision when it's not performing? Like, where's the capital going to go then? So it's all about kind of just understanding and having sensible rationale about kind of what we're holding.
Perfect. Okay. And so that leads us on to the question then, what is a non-speculative asset, or perhaps infrastructure plays? Would that be like the opposite or slightly different?
So basically, so let's look at infrastructure, right? This is again a category that I've just created, and I kind of see assets like, and I put DEX, so I kind of looking at any token that is associated with a DEX where we can
like
kind
a
of,
Uniswap, like a Sushi Swap,
yeah,
like a
something
One
like
Inch, that kind of stuff.
Uni's not that productive, but there's other assets that you can basically capture revenue and transaction fees. So looking at kind of infrastructure plays and how I would associate that on kind of my balance sheet, or so basically I look at it as YLD is the perfect kind of example, because it's basically you buy, if you go on the website, you look at the calculator, you put 20,000 coins in, you buy those at whatever price you can get them at, and then you basically lock that in effectively into your balance sheet, and then you're generating a higher yield. So you're basically buying, it's like buying pizza ovens or bread ovens, where the YLD will sit on the in the shop, and then it's basically just printing out more bread for you. And then the second you take it out the shop, there's less bread coming out of the oven. So really looking at it as core infrastructure, where we're not looking at the price of YLD. Okay, it's down to 30. Okay, it's up to 70. Oh, it's at $1. I'm going to sell it. Never selling it, just having it there. You're never going to, if we had a bread shop and we were selling loaves of bread and then all of a sudden the oven went up 50x, and because somebody else wanted to buy your oven 50x, you're not going to sell it if you're really creating a good cash flow out of that business. So that's the way I kind of see that asset, and obviously accumulating as much YLD as you can just to achieve that, and then locking it on the balance sheet is I'm not a financial advisor, but it's probably a sensible thing to do, right? If you're using a platform like Yield App. So yeah, there's a lot of different attributes and things with infrastructure assets. You can collateralize and then the other thing that we kind of didn't discuss there, basically it's a bread oven that is, again, it's appreciating at the same time, and you're able to generate yield off the bread oven apart from the bread. So it's like when we really look and break this stuff down, it's like crazy. It's like a bread oven on steroids, where
so you can have your bread and eat it, is what you're saying.
Yeah, that's it. Or a cake, or a cake oven.
You should have used it as a cake analogy instead.
That's it. That's it. Yeah, I'm going to change this now. It's cake. Yeah.
Yeah.
So like that's it. The oven's going up. The bread's coming out faster, and and it's just like it's winning on multi levels at the same time, and sometimes you can win 3, 4, 5 times at the same time with these digital assets, whilst not having the physical maintenance of a cake oven or a bread oven. So
and that's what you want, really.
Yeah, this is why this is so fascinating and why I'm so passionate about it, because it is the best business ever, because you basically sit there with a laptop and no staff and a ton of assets, which you can accumulate over a long period of time, over a long-term approach. And then you can basically create a really, really high-performing business from anywhere in the world. And then find the most tax-efficient entity if that's what you want to do, live in the country you want to live in and pay the appropriate taxes, whatever way you want to do it. And if we really take this approach, it's very, very powerful.
Right. Hashtag not financial advice. That leads us into actually a second question that wins 100 YLD. So just to point out that the questions that I do read out will be the ones that win the 100 YLD each. This second question comes from MCKIJ11, snappy user handle on YouTube. And they ask, when investing in multiple coins, how do you determine how much to invest in each one with your budget? Should you also hold some stable coins in your portfolio?
So look, stable coins, it's impossible to ask the direct question, but obviously if you have $100,000, maybe holding some stable coins is wise. If you have $100, if you don't know what you're doing, holding the whole lot in stable coins is probably the right play, and depositing it somewhere where you're not going to lose it. So it's impossible to ask the direct question, but as with any business, yes, you should hold multiple different types of stock, multiple different strategies for winter, for summer, and you should stock accordingly as per the kind of the weather outside, the business that you're running. Diversification we've talked about. So if you really want to get somewhere in crypto, then obviously concentration at the right times with high quality assets is good too. So, and probably a lower stable coin amount. If you want predictable cash flow and you're 65, 70 years old and you don't want to take any risks, then stable coins is the way to go. So all mix and match. So it's impossible to answer the question directly, and because I don't know your circumstances, but basically the understanding of kind of what you have on the balance sheet is probably the biggest thing. And most people don't even understand what they've got. They're just like, I've got it because it's going to go up.
Right.
That's all.
Is there, if you're beginning from starting from the beginning rather, is there a way that you could say, okay, I'm going to have like 30% speculative, I'm going to have 40% infrastructure, then I'm going to have another 30 in stable coins? Would you, or is it just going to be a lot more individual than that?
It's probably a good baseline. I've worked with a lot of clients, and most people just come to me with a high. What most people come to me, Rebecca, is they're like, I want revenue and I want predictability, and these are highly intelligent people as well that usually come to me. And then they have the complete opposite. So their expression of kind of what they've bought doesn't really match what they're trying to achieve. And I see that time after time. And then once you kind of run the numbers and you do a breakdown, you put it in a spreadsheet, you kind of say, okay, here's your revenue. If you change it to this is what you get. If you de-risk it, often your revenue goes up in terms of using platforms again, like Yield App or whatever you want to use, that, putting that 20.5% into there, opposed to 0%, obviously increases the revenue, but obviously the upside diminishes. Or you can kind of do a bit of both. So you're earning in YLD whilst earning in dollars at the same time, 50-50, and then you have that exposure for the upside too. So there's no right way, probably balance. And for those who are kind of been around a bit longer, for those who really understand and want to take aggressive risks and know what they're doing, that's fine. And then for anyone beginner, don't take any risk and just learn, and then earn while you learn.
Seems a solid strategy, but not financial advice.
Yeah, correct. So basically, yeah, that's just what I kind of described. This is just a random portfolio. Don't go and buy these assets. Don't copy this because it's very out of date and you'll probably get destroyed. So don't do that.
don't be copying, guys.
Yeah, don't be copying because it's a bad portfolio. And I don't even know what the price of half these assets are anymore. But basically, this was something from a long time ago, and it's just an example to show, look, build the assets. How much revenue do you get out of it? How much is that a week? How much do you get a month? And then you can kind of project your business, basically, but forecast your business going forward. And that's kind of at 25% growth without really any speculative upside on the asset. So you're going to far out weigh these numbers if you structure it properly. And then obviously we can make a risk profile on the side just to say, okay, look, we're taking a lot of risk there. I don't really, when people see this visually, they kind of like, they freak out a lot because they don't actually realize the risk they're taking. So often the infrastructure part will be a lot smaller. The value storage part doesn't have to be 100% because again, that can cut in half, but just kind of, as Rebecca said, a mix and match approach, a well-rounded portfolio with some stability in it. If that's what you're kind of looking for, then that's the way. So we talked about like seasonal. So like with a shop, basically we have hot seasons like Christmas or Black Friday or whatever it is, and then obviously post Christmas things quieten down a bit more. It's the same with crypto. It's very like secular in its kind of nature. So there's times kind of when the market is consolidating, and you could argue this is one of those times now where kind of put in more dollars. And that's obviously not me telling you what to do because we could depreciate heavily from here. But just an example, there are times when we need to kind of stock up on goods in kind of bear market or consolidation periods, and then use those stable coins like the previous question. You said, should we have stable coins? Yes, at the right time to basically purchase depreciated assets or assets that kind of will go on kind of just increase over the next year or two. So there's times obviously when we deploy the idle capital and after crazy runs, and then rebalancing the books when the market is super hot. So this is very easy to kind of document out and show people here. I can tell 99% of people will not take this approach. When Bitcoin ran up to 65K, I was screaming at everybody to kind of just be conservative, not be too greedy, but everybody gets out of control. Everybody is just buying everything. And then we have that massive blow off top or liquidation event like we always do. So it's kind of knowing when the market is hot to kind of rebalance, allocate some into stables, increase your yield, don't be greedy, look at your business, look at the revenue per week, a month. And if we get that to a point that's life-changing, then we should start to really, execute on that rather than just looking at the overall dollar value, waiting for it to go to 1 million, 2 million, 5 million, and then it just crashes back down and we got no revenue at the end of the whole thing. So really looking at the monthly, weekly, daily payouts. Is that meaningful to you? What are your targets? And then really trying to seasonally kind of execute that on the market. So
but can we dig into that a little bit more, because
Sure.
the famous market adage is it's not timing the market, it's time in the market. A lot of people believe there is no way to time the market. So with that in mind, how can you take a seasonal approach, and what kinds of sort of really top level macro, i.e., global economic factors or whatever kind of seasonal factors should you be looking for?
So yeah, like you touched on it there, like picking the top is impossible. Hence why those arrows are nowhere near the top, because don't pick it. Just wait till you've kind of had experienced some upside. Or we all know when the market's hot, right? When all of our friends and family and every second person wants to get into Bitcoin, that's when it's hot. So we're in a bit of a tricky time now because a lot of people want that, and the market isn't particularly hot. So that's but there will be a time when literally everybody on the planet wants some Bitcoin, and that's just a huge indicator, because everybody will be asking, everybody's involved in crypto on this call. So yeah, aligning that with macro is kind of obviously with a pandemic that was easy in terms of it wasn't easy to execute and buy that crazy dip, but with the amount of inflation and different things going on, it was kind of obvious that Bitcoin was a kind of a flight to safety, if you like, or a good buy at that time. But this is very hard to execute. I hear everybody in our community, and I've spoken to over the years, is just like, yeah, I'm just going to buy this and sell this and go into stables at this time. 90 to 95% of people won't do it, and they won't be able to achieve it because they don't have the discipline to sell an asset and create a taxable event when they know that the asset's going to continue to go up. That's a very, very, very hard thing to do mentally, and most people won't execute it because they just get greedy and they just see the number changing daily, and they won't take that. They won't take that revenue stream approach. Looking at, okay, I had $500 a month. Now I've got $2,000 a month. I'm going to start to kind of lock that in. They won't do it. They'll like, I want $10,000 a month.
Let's get more, let's get more, let's get more, let's get more. And then, as it starts to fall down, it's like, it'll be okay, it'll recover, that famous kind of behavior market chart.
Yeah. So basically, there is no right time. The right time is whatever the right time is for you. And you have a plan at the beginning, and you have targets on revenue stream, not on overall dollar value. And you have targets in your life that are meaningful. For most people, it's, if I can earn $500 to $1,000 a month, my bills are paid. So that's the first meaningful target. If people live in, cheaper areas, then $500 a month is life changing. So what is life changing to you is not life changing to the next person. And then some people spend $500 a day just on rubbish. So it's
do they? Who are they?
Yeah, there's a lot. I live in Dubai. There's a lot of that going on. So so it's kind of having this methodology, kind of being aware of it, I would say, and kind of like really training your brain to kind of think about these things rather than, and just like if you have it there in your kind of mindset, then you're going to be more likely to execute on it rather than kind of trying to think about this stuff when we're in a parabolic run, when nobody's going to listen. 90% of my friends didn't listen to me in this. I did very well in the last run up, and it was the first time that I reallocated my portfolio in probably 2 years. So that's the kind of time horizons we're talking about. We're not talking about buying an asset now and selling it in 3 months. We're talking about multi-year time horizons. And when you get to those numbers that are meaningful, then you have to take action.
Yeah, absolutely. Well, but that sort of leads into a question that we've had from Justin, who asks, which assets do you consider to have the lowest risk but the highest yield? Because I guess we're touching on income here a little bit. So again, with the caveat that this is not financial advice and anything you hear is not a recommendation to invest, what do you consider to have the lowest risk but the highest yield, Kevin?
Stable coins. You can earn between 20 and 40% on stable coins just using Yield app. Like if you understand the power of kind of interest on steroids, and then if let's say you had the full 20,000 allocation, anybody I've been teaching people about this for 6 to 9 months now, and anybody that's done that was accumulating YLD at like 25 cents, 30 cents, and then it went up to 60. So you add that on top of another 10%, and you add that compounding on top, you're earning between 20 to 40% on dollars. So that's the lowest risk, highest speculation, because you're printing out speculative assets for free. Well, not for free, because you actually put your capital in there and it's the cost of capital, but you know what I mean? You're not taking a risk for buying those assets. And then, so and there's other ways to earn on stable coins in the ecosystem too. Obviously then it goes Bitcoin and Ethereum. and that only they are highly volatile. The yields, look, the yield on Ethereum and Yield app is highly attractive to me at the moment, 16.5%. You know, obviously that's not going to stay around forever, but that's a high upside on that asset, probably 2, 3, 4x, and then not financial advice, and then obviously a decent yield at the same time. So, you know, that's kind of the most obvious play in terms of like lowest risk kind of crypto asset alongside Bitcoin, and then everything else I would say is kind of just in the next bucket. But stablecoins are highly underrated. They give you so many options. There's many ways now to kind of lossless farm, invest, do different things, protect yourself, be patient and wait for downward trends, earn highly at the same time. You know, stablecoins are very, very underrated assets and kind of mocked a lot of the time. Why have you got stablecoins? But I think if you know what you're doing and you have a reasonable amount, whatever that means to you, then you can earn significant amounts of money with stablecoins.
I mean, right. I mean, you know, even the base APY on our stablecoins is 10.5%. I mean, the last time you could earn that, you know, outside of crypto was maybe the 70s. I don't know. I mean, it's pretty good. I mean, I come from the world of traditional finance, as you well know, and most asset managers in the traditional world that would promise 10% a year would be laughed out of the city. So it's pretty good. Basically, it's pretty good.
It's not advertised properly on your website because obviously you can't give that advice. But when you really do the calculations, I would
Right.
challenge people to kind of get a spreadsheet, map out over weekly, monthly, kind of what you can earn with a platform like this one. You can do it with other platforms as well, do it wherever you want. And then basically add in the compounding, add in the appreciation on the, you know, the incentivized yield, and you'll be surprised what you come out with. It's really
Right.
high. It's really high. Like, so obviously there's times for this when YLD's at 20 cents, you know, it's a very handsome risk reward. When it's at 30 cents, it's a handsome risk reward. When it's at $5, it's obviously a different proposition, right? So we need to, it's always seasonal. Like everything has its seasons. Yield app has its season. Other companies have their season. And then we have to kind of just analyze these things properly, talk about it properly, do some risk reward ratio on it all. And
Right.
yeah.
And if in fact, if you're not holding YLD with us, you can just hold stablecoins and you can still earn pretty much a market beating APY. So, I mean, and that's not just us either, of course, but everyone should invest with us. But that's not just us. So you don't even have to take that kind of company risk if you don't want to. Okay, so I'd love to move on to another question, if that's all right, because we've got a few coming in. So this is question number 4 for 100 YLD. This is from Danny Parker, a name I can pronounce. Thank you, Danny. I'm hopeless at names, as everybody that watches these videos probably knows. He says, what would be an example of a medium risk portfolio distribution for a long-term degen? Which is a trader of DeFi, I guess, is how in terms of offline cold storage versus harvesting productive assets and high risk yield farming. That's a nice meaty question from Danny. What's a medium risk portfolio?
Yeah, there's a lot of contradictions in there. We want high risk degen, medium, long term.
Medium risk portfolio distribution for a long term degen.
Look, medium risk is probably you know, I would categorize it as kind of Ethereum or something like that, because we kind of know with network effect and adoption and development that we're going to end up somewhere a lot higher in the future, just on the maths of it, right? So that's kind of medium risk. So let's say low risk is just stable coins, medium risk is Ethereum, and then everything else is high risk. So that's just my definition. Again, not financial advice. That's not the category definition on the internet or by a financial advisor. So that's just kind of how I see it. So that's very boring, just buying Ethereum and putting it in a wallet, but it's probably going to do very well if you just did that alone. So you talked about also cold storage and different things. So I challenge a lot of people on this as well. A lot of people say to me, Kev, you can't put these assets in these platforms and different things. And I'm like, okay, right, fair comment. But the question you've got to ask yourself is, can you custody those assets better than Yield app, better than the competition, better than that's basically the bet you're taking, that you believe as a retailer with one wallet and not being able to lose it and not losing your seed phrase, that you're basically going to be able to do a better job than somebody who's got, you know, a lot of firewalls, a lot of experts and deployed assets in cold wallets all over the place, and they kind of know what they're doing. So I'm not saying any company is any better than any individual, but I'm saying that's the kind of assessment you need to make. And
Right.
most of the time, the company probably could look. Does that mean you can access it straight away? No. Like, what if there's a run of people that want things all at one time? Obviously, we have to be in the queue and wait. So you've got to have these sensible kind of discussions with yourself. You know, can they look after it better than me? Yes or no. If they can't, then do it yourself. And then if they can, then maybe we need to increase the percentage that we put into these things. So look, if everybody could look after cash perfectly, we'd all have it under our beds, right? We choose the bank at 0% because we can't look after it better than the bank.
Right.
So the bank does a good job at looking after your cash. You go to the machine and it's there, right? For now.
My great grandmother once stored £4,000 under her mattress in cash over a number of years. It's a true story. Over a number of years, until the point when she was so elderly and unwell, she went into hospital. And then my grandmother flipped the mattress and found, this is a true story, and found £4,000 in sterling, old money as well. This is how long ago this was. This is before the UK switched to like the current monetary system. So they grabbed all of this money and they took it to the bank, and they asked the bank manager to honor it. And he said, well, okay, I mean, you know, I shouldn't really, but fine, I'll honor it and I'll put it in a bank account for you. And then my great grandmother was heartbroken, and she would just go around telling everybody how her daughter stole all of her money, because it was literally more important for her to have like the physical cash that she slept on every night. Do you know what I mean? So it's that sense of security through ownership. If somebody feels they can hold their crypto in their hand with a key, I guess that makes you feel safer. Are you safer? It's a question. Certainly,
It is
you know,
a question.
if you're a smaller investor, then perhaps you're not going to be targeted for a hack in the same way that a protocol might be. But, you know, also you can be like that poor guy in the UK who had 400 Bitcoin on his hard drive and accidentally threw it away.
It's not easy to self-custody. We should all learn. Most people think they're self-custodian and they just have a hot wallet. So the level of education and the barrier is high. So let's start as a new participant with somebody who's been in the market for a while and has a 100% track record. Does that mean they'll have that track record tomorrow? No, but let's make that risk assessment. And then even with yield app, you can take the insurance if you go to Nexus Mutual and stuff. I know they're going to have their own products, but there is an offer in there, right? So if you want to you're really that bothered, take the insurance cover as well. And I'm not saying that insurance is fail proof or whatever. I've not done it myself or claimed, but there's options everywhere. So it's making those sound assessments.
Right, absolutely. I have one final question, which I think is a really good question that I'd like to put to you, Kevin, if that's okay.
Sure.
Okay, so this is from Ox Jeff, and he says, Kevin, he or she, in fact, says, Kevin, if you should start over again today with all of the information that you have, but you only have $5,000 to start with, how would you set up your portfolio?
That's a difficult one.
It's a good one though, right? Let's pin you down.
If he told me,
you've got $5 grand.
If he told me what I was trying to achieve, I'll answer it.
Let's say you're trying to achieve, well, with 5,000, let's say growth. Let's say medium risk growth.
Medium risk growth. I didn't want to do anything in crypto, and I couldn't be bothered. I'd just buy Ethereum.
Okay.
That's really annoying. I wish you could give me 15,000. I'd buy Ethereum if I had 15,000, and I'd buy the YLD, and I'd put the Ethereum in the yield app, and I'd go away and I'd come back. When is it?
But could you do that with 5? You could buy what, one Ethereum?
A little bit, yeah. So like, I'd just buy Ethereum if I just couldn't be bothered, and I just wanted to do that, and I didn't want to learn, and I wanted something easy, and I wanted a pretty much not a guarantee, but a high probability that would work out over a couple of years. Then that's probably what I would do. Obviously, if I was like hungry and I was like really wanted to be a millionaire, or I really wanted to like be in this full time, I would probably take a bit more risk. But I would do that after like an insane amount of research. I would just like bury myself for like 3 months and not come out of the closet, and then make a concentrated bet. But most, that's that. And that I have done that before, by the way. So that's why I'm saying I would do it again. So yeah, basically when I got into crypto, I went off the face of the earth for like a year. I didn't come out of the house or anything, and within reason.
Wow.
Yeah, so that's why I got to where I got, because I put in a ridiculous amount of work. So if you're willing to put in a ridiculous amount of work, you could really, really, really try and get X's on it. If you're not that bothered and you just want kind of a life as well, just probably buy Ethereum.
Buy Ethereum. What did you start with then when you were beginning your crypto odyssey?
I got completely destroyed. That's why I'm good at teaching people, because I made all the errors. Like, and
Really?
I'm very proud of the errors, and it was my cost of education, and it's very, very big cost, huge cost. And it was very painful, like a lot of pain, a lot of anguish. I used to day trade. And I was actually a pretty good day trader. So I actually lost money on kind of the assets I was holding, went through a horrible cycle. But I didn't give up, and I just basically just carried on working for like 2.5 years in a really, really, really bad environment. But when the market turned, like I knew it had turned instantly. So I was like switched on, like a light bulb. The second the trend changed, I was all over it. So I was really able to capitalize. And obviously I'd gone through like a boot camp of hell for a number of years. So I was, that's why, and I think that I'm very grateful for that experience. Like that's kind of why I'm probably like I am now in terms of like risk strategy, and I'm not too greedy, but obviously we've all done really well at the same time. So yeah, just learn and just studied.
You live and you learn. Is there room to take, is there room for saying like, okay, you've got $5,000, buy an Ethereum, maybe put $1,000 into stable coins that you then earn a yield on, and then you've got what, 500, 1,000 left to make a complete random speculative play? What about something like that? Or do you think
that's fair as well? But you asked me the question, I would probably. Thing is, it's hard to answer, isn't it? Because it's like, how much pain has that person gone through to get $5,000? Is that like a month's salary, 2 months salary, or is that like 10 years work? So if it's 10 years work, I'll do probably a bit more of the Rebecca structure. So it is difficult, the psychology of that question and the kind of the perspective on it. But there's multiple ways to skin a cat, and probably if you just go YOLO into something as a newbie, you're probably going to get it wrong. Not because you're stupid, just because it's just easy to get things wrong out here, because it takes you a long time to kind of understand the asset class, and the kind of, it's not just like about an asset being good, it's about how the prices appreciate, how does capital flow, how does all these narratives get formed. So that's why I like centralized platforms. And a lot of people, kind of disagree with me, but I'm kind of like, this is a great place where you can't really lose that much money. And you can just basically, they do a lot of the hard work for you. So it's a great starting point. It's a great medium point, and it's a great end point with a portion of capital once you've got a lot of capital. So it has its place, and it's meaningful. Centralized offerings are very, very meaningful. And then you get to talk to people like Rebecca as well. And you have nice people to kind of bug when stuff goes wrong. And there's someone there. So it's like, that's
there's a person behind the wall.
There's a person behind the screen, yeah. So it's all good. I think centralized offerings are meaningful. They're definitely meaningful. And for institutions, obviously, definitely meaningful.
Well, we are at time now, so we're just over an hour. We, again, just to reiterate, we had 5 questions read out, and those 5 questions have won 100 YLD each, and they came from Malcolm Agris, they came from MCKIJLL, or 11, and the third one came from Justin, the fourth one from Danny Parker, and the fifth one from Ox Jeff. If you guys can email us at social@yield.app, then we'll make sure that you get your 100 YLD, because we might not be able to track you down via YouTube. So please do make sure you 5 guys email us at social@yield.app. So that's it for the second webinar. We do have one more coming up in 2 weeks' time, and we'll make sure that we email all of you to let you know when that's happening, what time it's happening, and what's going to be in it. In the meantime, where can they find you, Kevin? Where can the people find you?
So you can go to Yield Labs Twitter, so @Yield Labs, and then we'll come and find talk to the channel. It's not me. There's somebody else running it. So like, and then they will give you. I'll find the Twitter, the Telegram, and come into our Telegram. There's some people in the chat I see now. We've got a lot of females in our community. They're amazing, and we've got a lot of really cool discussion. A lot of yield app people in there. A lot of kind of from Terra. We've got people from Celsius. We've got people from everywhere. So like, all just come in. Let's discuss these things properly. Let's just have a good time in crypto and like help each other. And we collaborate with our channels. We do a lot of cool stuff. So, and we have a lot of things coming forward, but we're just kind of working on a lot of the intricacies in the background. So yeah, let's do it. Let's all collaborate together, and let's just make some money at the same time via a sensible risk managed approach.
Great minds make light work. I think I'm mixing my analogies there, but you know what I mean. Anyway, yeah, it's a really great forum and community, so guys, do get involved. You can find us at Yield App on your social media channel of choice, not TikTok yet, but as I've mentioned several times, we are trying to convince Tim, bear with us. He will be doing a dance on TikTok soon, I'm sure. Until then, we're going to have more AMAs, we're going to have Fridays with Yield App, and we're going to have more webinars. So stay tuned, and we will see you next time. Thank you for being with us. Thanks, Kevin.
Thank you, Rebecca.